Good morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Monday morning tariff angst for steel and aluminum as Trump warns on tariffs for all. The news flow underpins King, dollar, and steel stocks, all that ahead of inflation data and Chair Powell's testimony on Capitol Hill. And Elliott strikes again, building a stake in BP. Shares post the biggest surge since 2020. Good morning, Manus. Great to be back with you.
Danny, good morning. It is Monday morning angst for some parts of the market, but look at this. There's a stoicism to this equity market as we face new tariffs, 25% on steel, aluminium, China. We're counting down. Will they go live? Gradual tariffs for everybody. But right now, we're powering ahead. We've turned it around from 2 weeks of losses. The Mag 7 was down 2.5% last week. Roll it over, have a look at the bond market. There's a lot coming the bond market's way. There's massive issuance in 10s and 30s. We're waiting for the one-year inflation expectations from New York. What will that tell us post that politicized interpretation of inflation on Friday from Michigan? Bonds, 448 is where we stand at the moment, Danny. Good to have you back.
Great to be back, and you are spot on. The resilience of this market has been quite remarkable. Here are some areas where things are moving. U.S. steel this morning, Manus, that is rallying after, as you mentioned, nearly 4% pre-market. President Trump plans to impose 25% tariffs on all steel imports.
There are other metal stocks that are rallying. One of the biggest movers on the tariff news is the steel manufacturer Cleveland-Cliffs, rising more than 10%.
And away from the politics, T-Mobile also rising in the pre-market session. That is up also nearly 4%. It will be offering service with Starlink satellites for texting and data usage. $15 a month is the price tag on that after a free testing period.
And in just a few moments, Kit Juckes from Société. We'll talk through the FX machinations. Later this hour, Laurie Calvasina from RBC Capital Markets and Roxanne Varza, Station F Director, live from the Paris AI Summit.
But first, to the main headline that you kicked us off with this morning, Manus. President Trump planning to hit 25% tariffs on all imports of steel and aluminum into the U.S.
Any steel coming into the United States is going to have a 25% tariff.
What about aluminum, sir?
Aluminum, too.
10%?
No, 25%.
25 for aluminum as well?
25 for both.
Joining us for more is Bloomberg's Kevin Whitelaw. So, Kevin, we heard from the president there on Air Force One. What's expected today?
Well, I think we're still waiting to see what the actual paper is going to be and whether it is exactly as he described it, whether there's any exemptions, whether there's any timing details. Officials around the world, but also here in Europe, are just waiting to see because they say, well, we can't react to just something that's said in a statement. We really need to understand what the legal language is and exactly how that's going to play out.
Well, then, of course, the issue becomes who does he negotiate with in Europe? Kevin, thank you very much, setting the stage there from Air Force One for the markets this Monday morning. Well, with the further threat of tariffs looming over commodity markets, Kit Juckes of Société Générale writes this. Foreign investors own $65 trillion in U.S. assets, and if they get spooked, the repercussions could be significant. More fundamentally, tariffs work best when the country imposing them has enough slack. I'm pleased to say Kit Juckes joins us now. Kit, look, we have a three-way headline on tariffs today. In many ways, a replay of 2018. What is a real spook for this market? Because equities are standing up and there's small moves in the FX market, given some back. What's a real spook?
Well, a real spook is I think, going to come, if it comes, from inflation and from a rethink on where the Fed goes, just because the U.S. is pretty close to full employment at this point in time. It's growing pretty strongly, and tariffs will push prices up. That's the first thing that happens. Then we'll see what happens next. So if we get another push back up in Treasury yields on the back of concerns about inflation that start to grow, they're just sort of bubbling up a little bit now. That's the most dangerous thing that can happen for people who are invested in the U.S. equity market, people who are invested in the U.S. bond market. And we'll have to see how that plays out. Otherwise, say the U.S. economy is growing well. Inflation at the moment is edging high. It's being sort of stubborn, but it's not out of control yet. So they're in a very good place, reflected in a very strong dollar. The problem is inflation if it picks up much further and changes the Fed story.
There are other threats out there besides just inflation, and I think we got a hint of one. Again, the market didn't seem to react, but that was President Trump talking about irregularities in the Treasury market. Sorry, kid, it's a Monday morning. But basically seeming to suggest that they could selectively not pay some of the sovereign debt. Kit, if that were to be the case, presumably that would set off a type of financial crisis that would be greater than anything that tariffs would bring on. But the market shrugged it off. What do you make of that? Should we be taking some of these threats more seriously?
Well, we should note them. I mean, you're right. You know, the one way of scaring investors is if you start not paying interest or not paying back the principal on your debt. That's true everywhere. And I'm not sure markets are particularly fussy about sort of the fancy reasons why you might be doing it, saying there's some irregularities. So we'll have to see how it plays out. I think the market's reaction to this is to, just lodge it somewhere in the back of its collective mind, but assume that this isn't happening.
Part of the musculature of this dollar is rates. The other part of it is geopolitical, the geopolitical framework. If we look at the Munich conference, the possibility of an off-ramp between Russia, Ukraine, the Gaza ceasefire holding, and some kind of trade detente before the end of the year, or maybe even sooner, Kit. How much of that geopolitical angst coming out can perhaps take some of the heat out of the dollar?
Oh, quite a lot. I mean, you've got to start from the perspective, say that, the dollar has risen to its highest level since 1985 on the back of massive inflows into the US equity market, massive inflows into the bond market, concerns about Europe and the war and so on. So we're up here on a lot of that kind of news. You tip the thing back the other way, and you can start quite a big move if you get optimistic about other parts of the world, because, for example, we take the heat out of trade and we bring an end to that dreadful war. I mean, remember, back in 1985, once the dollar had been turned around by James Baker and Ronald Reagan, it went miles lower without there being a recession. So, when you get so much of the world's money invested in one currency, once it starts thinking that currency is going down, it can sort of get a momentum of its own. So far, we can see potential catalysts, and we're sitting waiting, trying to figure out what odds to put on them.
Kate, you're speaking to some real asymmetry that is priced into this currency market at the moment, and the potential for things like euro to rally. Given that asymmetry, how much more room is there for further dollar strength, for further euro weakness?
I mean, it can sort of grind a little bit every week or so and drive me, to be quite honest, completely mad. So I wouldn't rule it out. I'll go back to my only line about this, but in my first job in Frankfurt in 1984-5, I asked the head trader of the German Bundesbank how high the dollar could go. And he said, "Kid, I don't know. We intervene every day. It goes up every day." And I thought he was the smartest bloke I knew. So I'm not wise enough to know how far to go. I don't see any justification for us going back to the 2022 highs when we had, a massive terms of trade crisis as a result of the war in Ukraine had just been unleashed on Europe and was positive for the first time for the US in that sense. This isn't, we're not back at that point, but the market is very long. If it keeps on buying and it keeps on liking US yields and it keeps on liking the US growth story, we just edge slowly higher, and I edge slightly closer to taking out the rest of my hair.
Okay, Kit, I can't respond on that because, it's a touchy subject. Scott Bessent reaffirmed the strong dollar last week. Is there a political tipping point on what's a comfortably strong dollar?
Well, yes, there is. And again, you go back to 1985 when, it was Congress threatening tariffs, concerned about job losses in manufacturing, that persuaded President Reagan to start trying to do something. This time, tariffs are intended to protect U.S. steel. Clearly, in this instance, U.S. manufacturing, a lot of blue-collar jobs are threatened in this environment of a strong dollar. So it's not surprising President Trump doesn't want a strong dollar. It's a question of how that political will is translated into action that would weaken it.
Well, Kit, I just have to say thanks for not responding to all of our questions with "I don't know, Kid," because no one could fault you for that being the answer in these times, Kit. Thank you so much for joining us this morning. It's always a pleasure to have you on. Kit Juckes of SocGen. Let's get you some other top stories now that are trending on the terminal this morning. President Trump has suggested that Elon Musk's Doge team, as we were just discussing, found irregularities in U.S. Treasury Department data. He didn't elaborate on what problems Musk discovered, but implied that U.S. debt could have less debt than originally thought. The White House did not immediately respond to a request to clarify.
Shows BP jumping after Elliott Investment Management built a stake in the company. The intervention comes after BP has stumbled through a series of missteps over the past 15 years. Sources say that Elliott is seeking to boost shareholder value by pushing BP to consider transformative measures.
TSMC says its first quarter sales will be at the lower end of its forecast range. There were several earthquakes that affected production in January. Still, TSMC maintained its first quarter gross profit margin forecast and upheld its full year outlook. Meanwhile, NVIDIA AI server maker Hon Hai signaled a stronger revenue outlook.
Coming up, France hosting the AI Action Summit. We're live to Paris in just a few minutes, right here on Bloomberg Brief.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Now to France, where the AI Action Summit has kicked off. World leaders, including German Chancellor Olaf Scholz, U.S. Vice President J.D. Vance, and possibly the Chinese Vice Premier are gathering in Paris. Let's head over there for a conversation and a special guest with Bloomberg's Tom McKenzie. Tom.
Danny, thank you. Yes, joined now by Roxanne Varza, who is the director of Station F, which is, on some metrics at least, the largest tech incubator, at least by space, in the world. Based here in Paris, they've got over 1,000 members, so a touch point, a finger on the pulse of what the European startup community needs when it comes to AI. Roxanne, thank you for joining us. Also an investor yourself as well, of course. What does your community need? What do European startups need to deliver and drive forward on AI, given the competition coming through from the US and China?
Well, it's a very good question, but I think we've been very pleased with some of the announcements that have already been made. So I would have said investment if you had asked me the question maybe a few hours ago.
Is it enough?
Is it enough? I think it's a very good amount. I think it puts us on par with, at least if you look at it on a per capita level, on par with what has been announced.
The commitment around over 100 billion euros
100 billion, yes. Over the next
things like
few
data
years.
centers and infrastructure in France.
Exactly.
Over the next few years. You think it's enough, but you want to see how it's implemented?
Well, is it enough? Could we go for more? Yes, we can always go for more. We would like to see more. So that would be one thing on the radar. I think we have excellent talent. I would say the next thing that we need is exits. And I don't think it's specific to AI. I think it's across the ecosystem. It's something we talk about a lot in Europe. How do we get more exits?
When you think of exits, you think of the US, and that market, in terms of the capital markets of the US, still compelling then for your startup community. They're looking to the US still to list if an IPO is on their radar.
Anybody wants to list, usually they look towards the US, yes.
So how do we change that metric? Do we need to change that?
Well, we definitely need to solve the liquidity problem. So maybe there's another way to do it. We have to see what that means. We don't have as many acquisitions. I think acquirers are also very foreign-based, so that could be something that we work on as well. But we will have to at some point address that problem.
Do you see a tick-up in exits in 2025, whether it's via private equity, whether it's being sold in sector, whether it's IPOs? Is there a pickup in momentum that you're seeing?
There was more consolidation. I don't know that it's always necessarily for strategic reasons. It could also be because some companies are not able to raise, for example, another round. So I think there was more consolidation last year, but we'd like to see more strategic mergers and acquisitions.
What is your level of confidence that Europe will be an AI innovator, not just an AI taker and receiver of services built and designed and shipped out of the US?
I'm very, very confident. I think what we're seeing on the ground, at least in the early stage, is incredible innovation. We have some remarkable talent that's actually now leaving other geographies to come build their companies here. We're seeing all kinds of leading foreign investors coming to fund these businesses. I'm very, very confident.
The regulatory framework and divergence could not be more stark. The Trump administration has ripped up what few AI rules there were at a federal level. In Europe, you have the EU AI Act embedding itself from this year.
Yes.
To what extent does that provide a roadblock? Or does it provide regulatory certainty, at least? for the tech and startup community. How do you think about the regulatory challenges? It is so stark now, the difference.
Yeah, I mean, I think my way of looking at it is regulation at some point is going to be necessary. So whether you rip it up and you put it in the garbage, at some point it's gonna be required. I do think that, yes, in some ways it does slow things down, but I do think it's there also for a reason and to protect people. So, I mean, I think there's a trade-off, and so far what we've seen, though, is that the companies here have a consciousness that it needs to exist, and they're looking at how can we work with the policymakers to make sure that it actually takes into account what we need. So I think there will be adjustment. Usually people, they set up a framework and you have to adjust as things go forward.
And look, you've straddled both the US and Europe in terms of, you spent a lot of time there, you've had experience there. You're from, obviously, the Valley originally, and now you're ensconced in the tech scene here in Europe. How much of a gap has opened up between China and the US and Europe? To what extent is Europe a laggard on AI?
Yes, I definitely think a lot of the discussion around AI has been in the US and in China, and Europe is really looking now to kind of bridge that gap. And I actually think we're not too far behind with some of the stuff that's going to be announced in the next few days and has already been announced. I do think that there's a huge opportunity also for Europe to be what some entrepreneurs locally are calling the third front or the third voice. We're seeing a US way of innovating, a Chinese way of innovating. We would also like to have a European way of innovating, and we don't want that to always be seen as regulation focused. There's a place that I think Europe definitely can take.
Which companies are you most excited about? Which products, which services? What stands out to you in terms of innovations that we as consumers or as businesses may be incorporating and using in the months and years ahead that you're most excited about?
That we're most excited about? Well, I have to say we're very proud at Station F because Hugging Face, which has become really a global AI leader, was built at Station F. We've had a number of incredible AI companies. I think some examples that come to mind just spontaneously are in the cyberspace, a company called Kevlar that's able to investigate some cyber attacks autonomously. We have another company that I saw here at the summit earlier called Spore Bio. They're going to be announcing some pretty cool things soon, but they actually are able to detect bacteria in food almost instantly, where normally you'd have to send it to a lab and get lab results. So I think there's a lot of really interesting applications. You mentioned Hugging Face, and they really are very prominent in the AI space, a really big name within the AI space, but of course, they've moved to the US. Yes, and that is something that we see in a lot of the...
They incubated here and moved to the US.
So what happens is these early stage companies will join programs like Y Combinator, or in the case of Hugging Face, I think it was BetaWorks. And those programs require that you move your headquarters to the US, and oftentimes the argument is the exit market. If you want to get acquired one day, if you want to go public one day, this is where it happens. So I want to change that here so that companies no longer have that excuse. Okay, you've set yourself a big challenge, and we wish you all the best. Before I let you go, DeepSeek, how are your companies thinking about DeepSeek and the impact of that Chinese innovation? DeepSeek definitely made a splash in the AI discussion. I do think it's interesting. We talk to a lot of our companies at Station F to see, are they using it, are they playing with it, experimenting? There is a lot of hesitation. I think there are some security risks. Some people have said they've actually started using DeepSeek and it's just not as performance as some of the OpenAI models, for example. So I think there's been a lot of excitement, but we'll have to see if it materializes. Roxanne, thank you very much indeed. Roxanne Varza, the director of Station F, the incubator here in France, with a mission to change the exits environment for European startups. Manus. I think everybody's hoping those exits stay opportunities for them. Tom, great conversation. Tom McKenzie there at the AI conference in Paris. Coming up with Danny and I, the Eagles down the Chiefs. Your front page news. That's next on Bloomberg Brief. It's Bloomberg Brief this Monday morning. I'm Manus Graney alongside Danny Berger. We're back together. It's not a good situation. Front page news. There's too much hilarity on this set. First up, we'll go with the Financial Times. Take it away. Off there. They're leading with Germany's election frontrunner Friedrich Merz saying that he was open to reform the country's strict borrowing rules. In a televised debate, he came under pressure about how he would finance higher defence spending. Chancellor Olaf Scholz said it was ridiculous to claim spending cuts
could provide the billions of dollars needed to finance bigger defense budgets.
Meanwhile, Manus, we have this one. Shein is asking some of its top apparel suppliers to set up production in Vietnam. The idea being that it would mitigate the impact of new U.S. tariffs on Chinese goods. They're also offering incentives that include higher procurement prices of 15 to 30% and higher orders.
And the New York Times, along with many other media outlets, go with this Super Bowl. Philly Eagles dominating the Super Bowl, winning against the Kansas City Chiefs 40-22. The Eagles started with a commanding lead, 24-0 by the end of the first half. Can you imagine that dressing room at halftime? President Trump, of course, the president there. Can you imagine going into the dressing room halftime, 24 down?
We call it the locker room in America. Just by the way, this is my favorite segment every morning on Bloomberg Brief. Manus Cranny talks American sports. Let me tell you, Manus, it was a big deal. We haven't had a blowout Super Bowl since like the 90s? So it's kind of nice to see it back. Not that I stayed up to watch it. I feel like I need to be clear and honest about this. I was fully asleep, woke up at midnight, checked my phone. Oh, that's good. The Chiefs didn't win again. Phone down, back to sleep.
She secretly watched Kendrick Lamar just to see what she didn't stay on the phone for the full 13 minutes. I think when you look at the sports betting on this, I think for me that's what caught my eye. $1.39 billion in terms of bets on this Super Bowl. That trumped last year.
Yeah. By the way, there was this thing floating around that maybe Travis Kelce would propose to Taylor Swift at the end if they won. So there's this great meme of like Travis Kelce being really upset, being like, I had planned to propose. The team ruined my proposal. That's really what was at stake at the Super Bowl, Manus.
We keep it alive here on this show. I talk American sport. Danny corrects me, and we keep it alive. I'll tell you what, it was all about the Chiefs chicken nuggets. That's what really did it for me. I interviewed the guy that produced them on Friday, and that just blew my mind.
It's such an easy shape to cut. It's just an arrow for the Kansas City Chiefs.
You have just crushed the dreams of the chef.
All right, we're going to talk markets next. We'll get serious, we promise. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger and Manus Cranny. Let's set your agenda.
Monday morning tariff angst for steel and aluminum as Trump warns on tariffs for all. The news flow underpins King dollar and steel stocks. That's ahead of inflation data and Chair Powell's testimony on Capitol Hill. And Elliott strikes again, building a stake in BP. Shares post the biggest surge since 2020. Good morning, Dari. Lots to welcome you back to.
That's certainly right. But hey, if I were to come back and just look at equity markets, I would say there's no news at all, or maybe just only good news. We continue to trot higher. S&P futures up 0.4%. NASDAQ outperforms 0.6% despite the tariff threats, despite irregularities in the Treasury market. That might mean maybe the U.S. doesn't pay all of its debt. Treasuries also just hanging for time at this moment this morning. Unchanged on your U.S. 10-year yield, just under 4.5%. It was a jobs data on Friday that was somewhat strong that led us to price out more rate cuts. We are pricing in just over one full quarter-point cut for the entirety of 2025, Manus.
And then, of course, we saw those big shifts in the inflation expectations, more from New York today. Let's talk about President Trump. He's unveiling plans for tariffs on all imports of steel and aluminum into the U.S. Here's what the president had to say on Air Force One.
Any steel coming into the United States is going to have a 25% tariff.
What about aluminum, sir?
Aluminum, too.
10%?
25%.
25 for aluminum as well.
25 for both.
Brendan Murray tracks the trade for Bloomberg around the world. Brendan, this is very much a Canadian sore point relative to Mexico, relative to the United Arab Emirates. Another salvo bolstering steel stocks here in the U.S. Talk us through the triple threat today in trade.
Yeah, so for America's trading partners, this was a bit of deja vu. If you remember, the Trump administration, during its first term, slapped tariffs on steel and aluminum. This time, the aluminum tariff is higher. It's 25%. It was 10% 5 or 6 years ago. And so Canada is by far the biggest supplier of U.S. aluminum imports. And so this is really going to hit them hard. The American aluminum industry even said a couple of days ago, please exempt Canada from these. But apparently they won't be. We have to wait for the official paperwork. the Europeans have said we will not respond to the comments. We will wait till the official filings are made to determine how or whether we will retaliate. But you can bet that the Europeans are ready to retaliate to kick in some of the tariffs on products that they targeted last time: Harley-Davidson motorcycles, Levi's jeans, and some other sort of iconic American exports. So this is just the latest in the series of trade offensives that President Trump has laid out. What exactly the details are, we don't know yet, but we'll find out presumably in the next day or two.
Brendan, you said it, the latest in a series. It's as if we already forgot about the 24-hour trade wars that we've seen before, which still haven't been resolved. What is the expectations for tariffs from a more holistic level, not just the steel and aluminum, but what we might see, for example, on Europe and China and our neighbors to the north and south?
Yeah, exactly. So there's this other idea that he's floated of reciprocal tariffs. That's basically the equivalent tariff of what a trading partner charges our goods. So there's a lot of confusion about what exactly that would mean and how it would be implemented. But that would take things to a whole nother level as well. But that we could be the president signaled that that's something that's coming more midweek. So the market is trying to digest these steel and aluminum tariffs. So far, the market reaction is fairly muted, presumably waiting for details to find out exactly who's getting hit and whether there would be any exemptions like there were last time.
Yeah, uncertainty seems to be the name of the game. Brendan, thank you so much. Bloomberg's Brendan Murray there. Speaking of that, RBC's Lori Calvasina and her team have been digging through the latest from corporate America and their earnings and what they've been saying on earnings call. She writes that on the general outlook and macro backdrop, we lost count of the number of times a company used the word fluid to describe current conditions. Other descriptions of the backdrop included cautious, uncertainty, sluggish, softer, challenging, and evolving. All afterwards, for the moment we're in, Lori joins us now. She's head of U.S. equity strategy at RBC Capital Markets. Lori, I love this. It's perfect for where we are right now, the uncertainty. You go on in your note to mention that earnings are softening, but still strong. At what point does that uncertainty actually hit the earnings figures and cause not just softening, but weakness?
It's a great question. And, you know, it's interesting because companies did also emphasize some good things, right? But the title of our note this week was that basically uncertainty dented the optimism. And I think that's what we've seen. It hasn't derailed it. We are still seeing, you know, a decent amount of optimistic comments coming through. People are still talking about a resilient consumer and that sort of thing. But I do think what's interesting is this idea of, you know, post-election, pre-election, everything was frozen. We were supposed to see this big unleashing of activity. Companies aren't talking about that. They're not seeing it. It's been replaced by this cloud of uncertainty. How long it can go on, I'm not quite sure. If you go back to 2018, the thing I remember about that trade war was that the first half of the year, and I think it sort of started in January, really ramped up in March, and there was a lot of optimism that the U.S. would come through unscathed. I saw that in small cap stock performance and positioning, which really surged through June on the performance. And then I think the positioning actually kept going up through September. What I really remember about that year was that it was post-Labor Day. It was that conference season for 2Q. I was at our industrial conference for RBC. I remember that was really the wake-up call. There are tons of conferences that happen in September, and that's when companies came out and said, not so fast. This is going to hurt. So it may not take quite that amount of time, but it does take a little while for people to get their arms around this kind of stuff.
We just spent the first half of the show talking to Kit Juckes about the dollar, the strength of the dollar, how full the dollar valuation is. 40% of the earnings calls talked about the dollar. And this takes us back to 2018. The risk from the dollar, the consequential risk of the dollar to an earnings recession, that's what some people are talking about, which could be seen as extreme.
Yeah, it depends on what happens from here, to be honest. I mean, so far, we've absolutely noticed in our earnings reviews. Didn't see it so much at the beginning when it was mostly financials, but as we got into the industrials and the healthcare companies and now some consumer companies. So you're seeing a lot of different industries talk about this dollar issue. And I think one company actually called it a torture test. I forget which one that was, but they referred to like all the volatility in the backdrop there. And it's having a pinch now. It's not unmeaningful. I mean, it's not unmanageable at this point. They seem to be, you know, sort of handling it. I was talking to one of my analysts about this, and their company, you know, had missed in part because of this. And I said, well, I feel like I've done this forever, and we all know this issue is coming, and it's never baked into the model, so what gives? And they gave me a very thoughtful response, was that usually the sort of underlying fundamentals are so strong, it kind of papers over a lot of that currency risk. And so I think that's some of what's going on right now as well, is that it's getting noticed because it's not getting made up for.
Right, by the way, producer Assad writes in to say it is Philip Morris that said the torture test comments. So you are spot on that. I mean, it's even remarkable to think about how different we were 2 months ago. Not necessarily the tariff threat, but it was this idea that deregulation would lead to an uptick in deals. Yet in January, the Wall Street Journal has a story out that it was the iciest January for deal volumes in basically a decade. Yeah. What does that mean for small caps? What does that mean for financials when this was supposed to be a really big driving force for them?
So I think the issue on M&A is a little bit nuanced. Everyone's been going around talking about, hey, there's going to be all this deregulation, animal spirits, corporates are going to be great, and we're going to get all this deal-making activity. What kind of deal-making activity have people been talking about, corporate to corporate or private equity? I think it's really been more private equity driven. That's not really my area of expertise, but I don't know that we were necessarily going to get all this corporate to corporate anyway, because I think if you dug down on that bullish M&A thesis, it was about other actors. I do think, though, as we kind of look at the iciness that's returned, and there's a little bit of a chill that we're starting to sense in these transcripts, and I would say that chill factor was dialed up a bit last week. It affects a lot of different things, right? It's not just M&A. It affects CapEx. It affects hiring plans. It affects investment. And, you know, we're not seeing a lot of downward guidance. That's good news right now. We did see that a year ago. But on, you know, even though, you know, we can all sort of breathe a sigh of relief that we're not getting a ton of that right now, that actually ended up being a good thing last year because the earnings bar was beatable and we didn't really see estimates come down the way they typically do. We're kind of not getting bad news out of the way early the way we did last year, which means it could come if there's a reason for it to come.
Would one big, beautiful bill ensure that you don't have to dust off your bear case? You talk about the fluidity. Yeah. You say, I'm not inclined to reach into the bag and pull out the bear case. Yeah. Would that reinforce the corporate narrative, the corporate tax, and the consumer if it was one big, beautiful bill?
I would say when we're thinking about that bear case, and you know, for people at home, we have our 6,600 base case. Yep. We've calculated what the bear case would be if we need to go to that, and that's about 57.75. Some of the triggers for that, I would say, number one, on the vibes. You can look at that predominantly through GDP. We're sitting at 2.2 consensus GDP. If we shave off 0.5%, that's going to put us back down into a range that's typically difficult for the stock market to do well. And if you also think about 10-year Treasury yields, I'm less worried about this one right now, but if you were to move to 5% on the 10-year Treasury yield, that would flip a couple of my models into very negative territory on the valuation side and the earnings yield gap model as well. Now, I would say, as we're thinking about the one big, beautiful bill, it really depends on what's in there. And I do think just getting some certainty back in the market is a positive, regardless of what it is. You know, I'm still concerned, and this has not been talked about as much lately, but post-election, there was some commentary of maybe let's put some tariff in the tax bill to, you know, kind of help pay for that. I'm not sure how that would shake out. I feel like not a lot of people remember that was being discussed. And also, what about taxes? Post-election, I remember a number of analysts whose companies don't actually make things in the U.S. going around saying, hey, my companies might get a tax cut to 15%. Yeah. And the language I've heard around a 15% rate is for domestic producers. So what are the nuances around that? Now, let's just say you don't get that big, you know, chunky cut. Maybe that's just a short-term problem the markets have to digest, and the certainty ends up helping anyway. We're going to have to see what's in there.
Maybe that plays back into your rotation, or as you say, in those small caps relative to the big caps. Laurie, thank you very much. That's all we can squeeze in for today. Great conversation. Laurie Calvasina there of RBC Capital Markets. Coming up, irregularities, as Danny has been saying, in the Treasury market. What are they? That is the claim from President Trump. More on the story next on Bloomberg.
There could be a problem. You've been reading about that with treasuries. And that could be an interesting problem because it could be that a lot of those things don't count. In other words, that some of that stuff that we're finding is very fraudulent. Therefore, maybe we have less debt than we thought of. Think of that.
That was President Trump suggesting that Elon Musk's government efficiency team has found irregularities in the U.S. Treasury data. What are those, and what are the risks to the Treasury market Kevin Whitelaw has been tracking this story. I mean, this is, again, another kind of sort of, throwaway statement on Air Force One. There could be a problem. You've been reading about it. That's with Treasuries. So what exactly do we know? What exactly is he referring to, and what are the potential outcomes?
I'm not sure we really know exactly what he's referring to, but we do know that Elon Musk and his team of people over at Treasury have been combing through some of the data from Treasury's payment system. So this is the system that pays the bills for the U.S. government. They were at least doing this up until a judge stopped them from doing it. But along the way, they were finding lots of payments that they were posting about, talking about on social media, suggesting that some of them may be somewhat problematic or were lacking clear data. Look, these guys are plugging into one of the most complex systems in the U.S. government, in enormous amounts of money, enormous volumes of things flowing through there, a lot of it routine business of the United States government. So we don't really know for sure whether they're actually discovering anything that is truly questionable or has some issues with it, or whether they simply don't understand yet what it is they're actually looking at. And then beyond that, obviously, we don't know exactly whether Trump is referring to, that process, or whether there's yet again something else that we don't really know about. But as of now, at least, it doesn't appear to be bond related, which is, I think, what most people think of when they hear about treasuries.
Right. Well, the idea of Trump more or less implying that they might not pay some portion of U.S. government debt is one that would have some serious consequences, but as we've all been pointing to, the market shrugs it off. The order of things, Kevin, has always been really important, and what we've gotten thus far is a lot of tariff talk, a lot of back and forth, less so on actionable policy around tax. Politico reporting that the Republicans are privately warring over just how might the tax debate take shape. The Democrats, the New York Times, say are looking at pushing something of a government shutdown when the March 14th spending deadline comes for the bill. Kevin, how contentious do talks seem at the moment for getting these items done?
Well, it's one of these things where you've obviously seen the Republicans in the Senate have no interest yet so far in standing up to Trump or putting their own stamp on his decisions, whether it's nominees or, decisions about closing down government agencies. But when it comes to sort of tax and spending decisions, these are going to be things that they actually have to pass. They're going to have to actually get something done. And when you're talking about the kind of margin of control that Republicans have in the House in particular, it is minuscule. And it means that only a handful of people can get in the way of this. And it's a very raucous caucus, and it's going to be very challenging for them to be able to get anything through, particularly if it is big and sweeping. It won't stop them from trying, but it does mean that I'm not even sure the Democrats are going to have to deal with a shutdown threat. It's going to be challenging enough for the Republicans to push anything through, particularly with the kind of sweeping nature that that Trump's talking about. They all have to worry about getting reelected in 2 years.
Kevin, we appreciate the update. A lot of threads to follow. Bloomberg's Kevin Whitelaw there. Just quickly want to mention some other D.C. news over the weekend. Elon Musk said that he is not interested in buying TikTok's U.S. business. He joined the WELT, the Welt Economic Summit, remotely last month via a video, which was made public by the Die Welt newspaper on Saturday. This was the first time that he had spoke on the topic.
Yep, you just got to keep an eye on who else is in the running there, various names in the frame. There is one stock that is on the move today. It is BP, soaring. The most since 2020, the activist investor Elliott built a stake in the company at the end of many years of underperformance. Joining us now is Will Kennedy. Will, when we look at Elliott, I mean, they've just had a glorious win with Honeywell. What do we understand that they may want with BP? Is it a full breakup you think they'll push for? Cash, the dividend's been under a bit of a question mark. Or is it just a big, bad shake-up?
Yes, I think that they will press on the thing that has been talked about already, and actually the management team has been working towards, which is to move away from this net zero, this aggressive energy transition strategy set by the last CEO, Bernard Looney, before he resigned, which would see them pare back oil and gas production and invest in renewables. Now, the current CEO, Mario Auchincloss, has been walking that back already. It's likely that Elliott will want to see that process go further and faster. What the transformative measures that they want, which we mentioned in our story, are, is as yet a little unclear. Breaking up oil majors is not straightforward because obviously they rely on a lot of vertical integration, refineries, oil fields, trading, and you don't necessarily want to mess with that. BP had started to hive off its renewables energy business, doing a deal to put it in a joint venture with a Japanese company. Maybe we'll see more along those lines.
We're going to get earnings from the oil giant, from BP, tomorrow, Will. What might we hear? What might this mean in terms of a setup for Elliott's actions?
Well, we've got two events this month, Danny. We've got earnings tomorrow, as you say, and they are likely to be relatively weak. We've seen that across the industry, refining margins in particular, a lot less stronger than they were 12 months ago. But perhaps more important is the Capital Markets Day that BP has planned in 2 weeks' time on the 26th, where we're going to have a strategic update from Murray Auchincloss, the CEO. And we imagine that Elliott will be talking to the management team in the days ahead and pushing him along the lines that we've discussed about really focusing on the oil and gas business and putting its emphasis back there. One other point I would make, Danny, is that the board has been around a long time. The chairman has been around a long time. If they really want to change the strategy, it may be that they're pushed for changes at that level as well.
BP shares up 6.4% in the London trade this morning. Will, thank you so much. Bloomberg's Will Kennedy. Coming up, Manus and I are going to set you up for the week. There's a lot to watch out for. There's CPI, there's Chair Powell's testimony. We'll break it down for you on your brief. You're watching Bloomberg Brief with Danny Berger and Manus Cranny in New York. Let's set you up for your trading week on this week. China's retaliatory tariffs on U.S. goods, those are scheduled to take effect today. Fed Chair Powell will also give his semi-annual monetary policy testimony to Congress. That happens on both Tuesday and Wednesday. Then also on Wednesday, we are going to get the latest U.S. CPI data. That will be followed by PPI on Thursday. Manus.
Yep, don't forget the macro. And of course, we have a little bit of auction. If you want to understand the personification of U.S. first, this is it. U.S. aluminum, steel stocks, all rallying on the back of the 25% tariffs. You've got U.S. steel. But look at that. Cleveland-Cliffs is powering ahead, Danny. This is about defense of U.S. steel. This is about defense of jobs. This is about the promises on the campaign trail writ large.
It is pretty incredible that the only actionable reaction we've had from markets on the threat of tariffs is to move stocks higher. For this overall market, Manus, if we look at S&P 500 futures this morning, they are just chugging ahead. It is the market's ability to shrug off what they hear from President Trump, which is quite remarkable. And you can't blame them, given what we've seen so far this year is trade wars beginning and ending in just 24 hours.
Well, you got to hand it to the irony of this. I mean, last week was the second week in which we dropped on equities. This morning, we're waking up to a three-way split on tariff risk. Will China tariffs go live later on today? Two, you've obviously got this new U.S. steel tariff of 25%. It's just like a fire hose that this market just sort of shrugs off. It's the FX market. Our favorite phrase of the day is the torture test in the FX market.
Yeah, Philip Morris mentioning that last week in their earnings, saying because of the currency volatility, or maybe it goes to Kit Juckes, the ultimate question, where how much more pain, how much further does this go? I don't know, kid. I think that has to be the answer for most of this. We just simply don't know. And Lori Calvasina talking about that companies discussing it on their earnings, that the uncertainty is denting their optimism. So
they've got two major risks. It's uncertainty. It's also the FX risk raised 40 times, about 40% of the earnings call talk about the FX risk. It's the inflation expectations. I love the way you've got Deutsche Bank talking about the politicization of the inflation expectations that we had on Friday. But we're going to get some New York inflation expectations later on this morning for the 1 year.
Yeah, and we'll also get CPI, PPI all this week. The macro still matters. Jobs was enough to send markets lower on Friday, Manus.
Indeed. And you've got a few auctions to come in 3s, 10s and 30s. Chow down on that at 4.5%. Surveillance team is up next.